Good morning, everybody, and welcome to our latest InSport Education Business of Sport webinar. Great to see so many returning viewers, and welcome to those who haven't joined us for one of these before. Delighted that we've got a seasoned campaigner for InSport webinars in Kieran joining us again today, and we've also got a first-timer in Roland Oakshett, who's also kindly given up his time. Our subject for discussion today is around Premier League club valuations, and I'm sure we'll talk a little bit about Chelsea specifically as a sort of exhibit A in this conversation. But firstly, I'd just like to ask Kieran first, and then Roland, just quick sort of 20-30 seconds on your background and relevance to this conversation. Kieran.
I'm Kieran Maguire from the University of Liverpool. I teach on the football MBA there. I've somehow managed to carve a position talking about the game to the media. I've written a book called The Price of Football, which people seem to buy, and I do a twice-weekly podcast called The Price of Football, which looks at things from the industry's perspective, which again is probably punching above its weight. And it's something I'm looking forward to have no need to do anymore. But the world of football keeps giving us the stories, so we have to keep talking about them.
Thanks, Kieran. Roland?
Hi, I'm Roland Oakshett. I was a banker for 13 years at Rothschild, specialising in M&A within consumer, retail and leisure, but particularly with a subsector specialism in sport, doing transactions principally in football within the Premier League. I've now moved over to the other side, and I work with an investor in sports, media and entertainment, a chap called Ricardo Silva at a company called Silva International. And amongst our portfolio of investments is a football club, Miami FC. It is not, before anyone asks, the Beckham Club. It is the other one. We play in the USL, the second division of the American Pyramid. The American Pyramid, which has no promotion and relegation. So the American flat line, I guess. But yes, that's me.
Thank you. That's a conversation for another day. Americans versus
has some relevance. Has some relevance.
I'm sure we'll come on to that. Thanks both. Great to have both of you join us today. So I suppose my opening gamut, and I must apologise that we haven't got our dear friend Rob Wilson with us, because he would love this subject of conversation, it being an area of expertise for him. But you're going to have to put up with my slightly less informed questions, I'm afraid. But we'll kick off. So Chelsea, obviously, slightly exhibit A in this conversation. Many sort of learned individuals, including Kieran and Rob and Dan Plumley, who I believe is on this webinar, and various models, including the Markham multivariate model, which is widely sort of accepted as a robust way of modelling value of football clubs. Various entities have valued Chelsea enterprise value in and around sort of 1.5 to 1.8 billion pounds. The club has, the Bowley consortium has just closed a deal out at 4.25. Now that's slightly disingenuous, because of that 4.25, 2.5 billion is the actual purchase price, and Todd and his consortium have committed 1.75 billion to further investments and benefit. But even at those headline figures, the 2.5 billion is, at a pretty juicy premium to the enterprise value. So I'm going to come to Kieran first and just ask a little bit. So that enterprise value, could you just briefly explain how you get to that, and then your views on perhaps why there's a bit of a difference there?
Well, enterprise value is deemed to be the value of all of the assets within the football club that help to generate income. So it's not just the assets on the balance sheet, it's the brand, it's the players that are coming through the academy and so on. And the way that is calculated comes from a variety of methods. You might look at some of the deals that have taken place in recent times and work out what's the value of the club compared to its revenue or compared to a profit metric. and then transfer that across to Chelsea. Or what you can do is you can try to work out, based on history, what's a reasonable assumption to determine Chelsea's cash flows going forwards, and then discount that to what we can to work out a value today. And then you say, right, well, that's the value of the business. It's a bit like saying that's the value of your house. And then you say, well, okay, who funds the house? You've got the mortgage lender, and then you've got the shareholders. So we then, once you've determined your enterprise value, you subtract the net debt, and that gives you the value of the shares. So that's where we are, and certainly when I've sort of plugged the numbers in, and I've only done quick and dirty. I don't have access to Chelsea's accounts. If you plug the numbers into Roman Abramovich's Chelsea, this is where we're getting this figure of 1.5 to 1.8 billion. Why we're getting different values coming out from the prospective purchasers is that they believe that a future Chelsea is not the same as a historic Chelsea, and they see either new income streams, NFTs would be an example, use of the metaverse, taking control potentially of the club's own broadcasting streams, taking them away from the Premier League, trying to extract more concessions from UEFA, because otherwise there's a new Super League being created. That's where I think those clubs or the club owners see the growth. Is it going to materialize? If I was doing a sales pitch, I would say yes. History tells us that that's not always the case. Yeah, we remember we've had 3D TV, which was going to revolutionize football. That didn't materialize. But there's a chance, and it's clear that these prospective owners believe that that's worth. When you factor those numbers in, those additional revenue streams, Chelsea becomes a more lucrative business. I think somebody was quoted in one of the papers only last week saying, well, potentially in a few years' time, this could be worth £10 billion. To which my reply was, well, if that is the case, why is Manchester United presently trading at a lower price than its launch price on the New York market in August 2012? So there's a lot of giddiness, I think. What else can be factored in? Chelsea is a trophy asset, and people pay premiums for, if you want a Banksy, if you want an Andy Warhol, if you want something which is unique and adds extra cachet to a normal investment, you have to pay a premium, and that's what we've seen in respect of Chelsea to date.
Thanks, Kieran. Roland, what's your views coming at it from the investor side? And if you're looking at this, where do you see that premium coming from?
Well, I mean, I wouldn't agree. I wouldn't disagree with anything that Kieran's just said, and that to do a sensible piece of analysis, you need to do just the sort of work that he's described, looking at comparators, looking at cash flows, trying to establish where the business growth is going to be and what the business looks like in 5 to 10 years' time. That last bit is the challenge. I think that's where people who have looked at this asset and said, okay, we think it might be worth $2.5 billion, have taken what I would describe as an optimistic view of the future. It's not unfair to look back at some of the previous transactions that have happened and to look at the commentary around those transactions and to recognize that people thought that when the Glazers bought Manchester United, they thought they were overpaying, or when Fenway bought Liverpool, they thought they were overpaying, and to say, well, that was incorrect then, and it might just as well be incorrect now. I think as a banker, it's often kind of slightly glib for us to say, but the market is the market, and there were enough bidders here to create a market. So it's rather ironic that Abramovich isn't going to see any of this money, but probably had the best sort of confluence of factors to create a good transaction that we have seen in the Premier League. He had a an environment where there is very cheap capital around. And he has a football club, which, as Kieran rightly described, is a trophy asset in the heart of London, which, coming out of coronavirus, is beginning to get back on its feet. And these assets trade very rarely. It is like a Warhol or a Banksy. I think if you look at the league itself, the Premier League, and the league that this club plays in, it plays in a slightly different league. It plays in the top six, and the top six trade even more rarely than those clubs in the Premier League. So, within that top six, you've got two clubs, I would say, that were available. You've got Tottenham and you've got Chelsea, and Chelsea are the more attractive. They are the club world champions. And more importantly, a transaction had to occur. I think a lot of people would say if you went to the owners of Tottenham and you offered them a price, then they might say, all right, your price is X. I quite like 1.2 times X. And that transaction may never be consummated. I think there's when people are looking at the opportunity cost, and particularly a fund like Clearlake, they want to do something. It's not worth their time sitting on the sidelines or not doing stuff. Yes, they will walk away from transactions, but they can't afford to spend a lot of time doing nothing. And that creates, in and of itself, a certain amount of drive to consummate a transaction.
Thanks, Ron. I mean, really interesting insights there on, I suppose, on the investment side, and your point there about putting capital to work. As I understand it, that a lot of these funds are, they want to get money out the door as quickly as they can, because fundamentally that's better business and better business for them. Kieran, bring it back to this notion of sort of trophy asset, and it's interesting to know that you both sort of referenced art, and without getting too philosophical about this, there's almost a sense that some of these football clubs and sports assets are moving almost closer to art than economics. The intrinsic value of the Marilyn Monroe, Andy Warhol painting is not very much if you price up the cost of the canvas and the paint and the wood. It's next to nothing. So it's been sold for 195 million quid. So the perceived value of that is extraordinary. And I sort of wonder where we are now in that redefining of trophy assets in the Premier League, where, yes, you can do all the economic modelling that you like, but there's a huge dollop of just sort of finger in the air kind of, as you said, Roland, these things come along once every 10, 20 years. And if you want it, you're really going to have to pay through the nose for it. I'm also interested, Roland, to get your point on the market and whether Rain Group, as the facilitators in that, will have set a sort of minimum bid. I mean, I think it's a bit of a coincidence that all these bids come in roughly around the same sort of number. I mean, surely somebody's had a word with them and said, listen, lads, 4 is your minimum. Let's see where you're going to go from there. So, Kieran, can I come to you first on the sort of perceived trophy asset bit, and then Ronan, I'll come to you on the 4 billion number.
In terms of what are you acquiring, you're not acquiring industrial. You're not acquiring retail, which is very transferable as far as bidders are concerned. You are, in acquiring Chelsea Football Club, being given cachet, notoriety, and fame that far outweighs the size of the business, the size of the industry itself. We've just seen Microsoft acquire Activision, the games company, for $65 billion. I don't know who the owners of Activision are. Most people don't. But if you were to ask who owns Chelsea Football Club to the people in the street, Roman Abramovich. Everybody knows who Roman Abramovich is. So by acquiring Chelsea Football Club, you acquire fame. And I think for people such as Todd Bowley, they quite like the idea of that and the benefits that brings. Chelsea, I mean, Roland said Chelsea's in London. It's not just in London. It's in the right place in London.
Having trudged up to Tottenham last night, for a phenomenal game, I might add, in an amazing stadium, but it's still a long way from central London.
Yes. So Chelsea is all of these things. So imagine that you are a prospective bidder for the club. You can now turn around to your business associates, the people that you want to impress, and say, would you like to come in the director's box of my football club in the sexy part of London? And we are hosting Arsenal or Liverpool or Manchester United next weekend. And that brings in value in itself because of the unique nature of what you're acquiring. It's not it's a unique asset. It's not a transferable asset in the sense that it's generic. And as Roland said, there's only two of the clubs up for sale. If somebody, I think somebody comes in for Manchester United and offers the Glazers $4 billion, then I think they would listen, because the growth which they'd hoped for isn't there. But certainly, FSG seem very happy with the returns at Liverpool. And clearly, there's no indication of Mansour, who is operating a trophy asset model, albeit from perhaps a slightly different perspective to Abramovich, is at City. So you pay a premium for the very elite, and that's what you're acquiring as far as Chelsea is concerned. And the timing is right. They are still just the Champions League holders. They are still just the World Club Cup holders. They do have the benefit of, they've already qualified for the Champions League next season. And also the news that we've just had coming out of UEFA over the course of the last 3 or 4 days, that effectively the Champions League, as far as Premier League clubs are concerned, effectively there's going to be 5 places from 2024 onwards. They've not been explicit in this, but given the incredible success that English clubs have had, the chances are that it will be an English club and probably a Spanish club that will pick up these 2 additional places each year. So the downside of the Premier League from an investor's point of view, and the reason why the Super League was so popular, was that 6 into 4 doesn't go in terms of those additional revenue streams. 6 into 5 goes a little bit easier. So again, that's something that they would have taken into consideration when they were doing the dynamics, when they were trying to work out how much to bid. Also, I can say that when Chelsea were first put up for sale by Abramovich, I put out some stuff to say, similar to Rob and the other guys, we're probably looking at 1.5 to 1.8 on the fundamentals. And I was actually phoned up by brokers and agents to say, you can't go saying this, because we are pitching the club at 2.5 to 3 billion. So keep your mouth shut. And if they'd offered me money, I would have done, but they didn't.
Noted. Roland, so just on the, I'm interested to understand a little bit more about the process of this sale, and obviously, Rain Group being appointed to rustle up a market, which they duly did. But the 4 and a bit billion number, I mean, how much of that do you think will have been, not manipulated is too strong a word, but will they have had a role in setting a base level in terms of investment and price, or has the efficiency of the market all come to the same conclusion, and does it actually work quite as well as that?
No, it doesn't work quite as well as that. They will have given indications, and I think usually it's not. In most of these transactions, it's not the Rain Group talking directly to Todd Boehly. It's the Rain Group talking to Todd Boehly's advisor and saying to him, look, if you're serious about this and you want to get through to the next round, then your number has to start with a 4 or whatever it might be. So I think it's no surprise that people were roughly there or thereabouts. I think the money that was put aside for the stadium, or has been put aside for the stadium, and the foundation and the investment in the women's team, I think that's good management by Rain, but something that they would have said, again, this is just a sort of cynic or non. You're not getting through unless you're making this sort of commitment. I'm sure there may be somewhere in some document some weasel words that say, well, if Ukrainian war extends into Belarus or wherever it might be, that actually it starts getting something that you might not have been able to predict at the time, but may affect European football, then maybe they don't have to put forward the entire 1.75. I don't know. That's a guess. But certainly when you're running a process, you give indications. You encourage people to get to where you want to. I don't think, and maybe it was something to do with sanctions, but I don't think it was. The appointment of Rain as a US investment bank, I think, was quite a smart move as well, because the whole point is to try and generate interest from abroad, particularly the US, where multiples are higher, where there's a conscious understanding that it's all about terminal value, that these businesses, like we made the example of art in the past. Art doesn't yield anything. You're not getting a cash flow from art, and unless you're creating your own museum and people are coming paying for it. Actually, what you're probably doing is getting a negative cash flow from it. You're having to pay the insurance, or increase your security. So you're buying it, you're getting negative cash flows, and then you're selling it. And you're hoping that the terminal value, the transaction when you sell it, is a lot more than the transaction when you bought it, so that it covers the cost over time, and you also have a profit on above over and above. And that's become the sports model within the Western Hemisphere, because a lot of these businesses don't make money. And now, football clubs, certainly in the English Premier League, were getting to the stage at which they might a couple of years ago, and they might return to that. In which case, I think you're looking at potentially a slightly different model. But when you are thinking about the people that you're competing with, not just one state actor, but two within the Premier League now. Some really very deep pockets. I can't imagine that many of these clubs are going to be running cash surpluses in the near future. And that might be that's actually a separate topic for discussion, because you wonder where Clear Lake are on that and their approach to debt. But the expectation will be that they are able to sell this for a multiple in advance of the one that they bought it, and that the media rights will be expanding, particularly the media rights will be expanding, such that their revenue figures go up as well. So I think they're expecting multiple arbitrage as well as growth within the revenue streams.
I mean, it's really interesting to get that view, and coming at this as a fairly ill-informed, certainly on the economics. I know I still come back to that notion that a business that is losing not just fractional sums of money, but is losing huge sums of money on a very, very regular weekly basis. How that can still be sort of valued at those sorts of numbers. Interestingly, had a call earlier this week with a chap called Tim Thomas, who's a partner at Liberty Corporate Finance, who's actually speaking on our private equity course in a few days' time. And it's very interesting to get his views on this. And he talked about sport and private equity's appetite for sport, and was almost incredulous that sport has many of the attributes that private equity hate. Uncertainty, unpredictability. There's a lot that highly complex stakeholder groups, lots of stuff there that under normal circumstances, private equity go, I'm not touching that. I'm not going near that football club that needs 900 grand a week, that's got a falling down stadium that we can't rebuild, and yet these businesses come flocking and pay a huge premium. So this sort of disconnect, the almost loss of, I don't know, people slightly not losing their head, because they're all very intelligent, sensible people, but parking those normal rules of engagement and saying, right, let's just ignore the rule book when it comes to Premier League football clubs. Because if you try and apply the same logic that would apply to buying a widget factory or an agency, these deals are never going to get through the door. So, again, the view on these, and Kieran, you alluded to this, that yes, some improved revenue streams that may come down the line. I mean, NFTs, yes, metaverse, lots of ifs and buts in there. That unpredictability. And Roland, your point about they're going to need to sell this at some stage, but we're moving now into the sort of realms of there aren't many buyers of if you want to sell this, if you want to double your money and you sell it for 10 billion in 10 years time, your universe of buyers is pretty small. So again, there's big risk in that. So I mean, how do you see that sort of those unpredictabilities? How do they park that, Roland? I'm going to come to you on this. How do these organizations get comfortable with all of that unpredictability?
You're right. It is unusual in that sense, certainly from a private equity sense. When I did private equity deals as a banker, not in sport, the desire frequently was to do an analysis of exit opportunities before you bought the asset. And that was to see what the market and the potential purchasers might look like in a 3 to 5 year period. And you can't do that with this sort of asset, partly, as you say, because the numbers are getting very much larger, but also you can't look at a 3 to 5 year period. No one has made money flipping a Premier League football club. It's impossible to do. You need patient capital. In fact, if you don't have patient capital, there's a high likelihood you might lose money.
But that in itself is sort of anathema to a standard PE time frame of 3 to 5 years.
Yeah, it is, and I think that's why it's perhaps somewhat surprising that Clearlake are there with Todd Bowley as a fund rather than as the individuals behind the fund, because I would have seen the individuals behind that fund who are billionaires in and of themselves who may well have been able to take the sort of patient capital route. I think a fund buying into this needs the ability possibly to roll into another fund, and we've seen that with CVC's investments. That you can create a situation in which you don't have that fund pressure, and we've seen it with Elliott. Basically, but Elliott's funds are slightly different in that they don't have fund pressure. They have a evergreen fund, so they don't have the sort of 3 to 5 year horizon. The challenge of flipping a football club in a 5 year period, again, as I said, you can't anticipate what the world will be like. You've got some very strong either recurring revenue streams or revenue streams that you can have in entire faith in. I said entire faith in. Okay, right. So the media rights and the ticketing revenue. I mean, if you've got 98 capacity across the league, so attendance capacity across the league, as we have done in the Premier League for the last 5 years, COVID notwithstanding, you've got a period, you've got revenue stream that you can entirely anticipate, and therefore that's why you're getting funding for stadium financing. You can build a stadium in Chelsea, changing it from 42,000 to 60,000, and know that those seats will be filled. You can do it in Tottenham, and as you said, it's a lot harder to get there. So that's hugely attractive to a private equity buyer. That sort of recurring revenue. The media rights structures on 3 year cycles, again, hugely attractive because you know what your revenues are going to be, and those sorts of features for private equity buyers are attractive. The challenge with those is that actually there are some effects of performance, which they can't control. It's completely without their control. And for that reason, as you said, these are not assets which naturally fit within a private equity basket.
Yeah. Thanks, Roland. I'll go to a couple of questions now, and there's a couple here that are sort of connected, and a sort of statement. William Paul, and we know William well. He was at Bridgepoint and sits on the board of Dorna, so he knows his way around the world of private equity and sport extremely well. An interesting point there about the appeal of these trophy assets to individual billionaires who really are the guys writing the checks and perhaps don't need to answer to shareholders or fund investors and the like. But it also links to Shubham's point there about, does Chelsea's position in the table matter? I mean, the point there, Roland, about perfect sort of scenario of Chelsea being, European club champions, Club World Cup champions. I mean, if there'd been sort of mid-table sort of mediocrity, whether they would have got the same sort of price. I mean, Kieran, what's your view on that? Do you think for something like Chelsea, given its track record of success, its location in central London, its profile, does it really matter if they're third in the table or eighth in the table? I mean, does the on-pitch performance have a massive impact on the value of the club?
First versus third or fourth doesn't matter. Fourth versus eighth does, because if in all of these calculations, people will be assuming that Chelsea are going to qualify for the Champions League 9 years out of 10 as a bare minimum, looking at their track record. And I think there's a case for saying we perhaps have reached maximum Premier League in terms of the domestic rights have been rolled over. And remember, the domestic rights are still at a discount to the price in 2017. With regards to other income streams, there is talk of Chelsea signing a deal with Whalefin for sleeve sponsor at 20 million next year, which I find slightly strange, given that the club is under sanctions and an embargo and is
apparently the deal was done before the embargo came into place, which is very convenient.
Cool. So that's something that they can pitch, and I think it is all a case of trying to, from a private equity point of view, just trying to de-risk as much as you can. And again, that goes back to the appeal of Super League, or having something as close to Super League as we possibly can. And the new news out of UEFA, I think, applies to that. So missing out on the Champions League next year is not an issue. Becoming Arsenal and missing out on it for 5 or 6 years on the trot, which I'm sure you're very sad about, Dan, is an issue. Chelsea expect to be in the Champions League. The revenues there are still growing. The flexibility which is built into the Swiss style model does allow for an expansion in terms of the number of fixtures, and also it reduces risk once you're there, because the nature of the competition is that the bigger clubs have an even bigger chance of getting past the group stages than they have at present. So all of that is factored into your valuations. Also, we have done all of these calculations based on historic data, where we had an owner who treated Chelsea Football Club as a glorified executive toy. So therefore, if you compare and contrast Chelsea to Liverpool, Liverpool have taken a scientific, data-driven, analytical approach to talent recruitment and retention, and that has paid off. If we take the period since the retirement of Sir Alex Ferguson in 2013, Chelsea have spent 1.3 billion on players, as have Manchester United, as have Manchester City. Liverpool spent 800 million. So on a 40% discount in terms of recruitment identification, they've managed to deliver in terms of success. And all of the new owners will have said, well, we come from an American franchise sport where Moneyball is part of the philosophy there. That was not the case of Abramovich at Chelsea, because he did tend to do things on a whim. It's certainly not been the case at Manchester United, because recruitment was driven by social media impact rather than talent recruitment. And if these bidders take a look at the success of Liverpool, they say, well, we can replicate that. And in the space of 10 years, Liverpool's acquired by FSG for 300 million. If Chelsea are benchmark at 2.5 billion, even, I teach in the city of Liverpool, I'll be the first to admit, I can probably get a house in L4 slightly cheaper than I can in Hammersmith and Fulham. But even if you put a slight discount in terms of your property assets, then it's still worth 2 billion. And you're looking at a multiple of 6-7 times over a 10-year period. That is appealing to PE.
Yeah, I mean, interesting. Thanks, Kieran. We'll just get into one or two other questions before we finish up. Steve's made a point here, and I'll come to Roland on this about. I think Clearlake have been prohibited from taking any dividends for 10 years. And we've talked about capital growth as the main sort of driver of a return. His question is, does this make the closed league model still a viable proposition? And my initial thoughts would be that it would make it if you've got a closed league, it makes it even more likely for capital growth if you've got a ring-fenced limited number of clubs that can compete in the Premier League. But how do you see that sort of Super League model versus current promotion relegation? I mean, right from taking this from the top of the call, we talked about the differences between American and European sport. How much of that do you think is a factor? These guys coming in thinking, taking a bit of a punt that in the next decade we're going to get to a closed league in the Premier League or a separate Super League that in itself can ensure some retained value within those clubs?
Certainly, if the league was closed, the valuations would rise. We would be much more like the US structures, where these are, it is a closed club of owners, and these are assets that trade once in a blue moon. And I think perhaps the American purchases of the last decade had a hope that we might move in that direction. I think post the challenges with the Super League, I think and certainly what we have recognised in the US in our challenge to get promotion relegation introduced there is that actually the structures of football move very slowly, and it's very difficult to assume that on the basis of an investment that you are making, that actually FIFA, UEFA, or whomever else would change the structure. I mean, I think that is more of a risk factor than a potential upside if you're looking at as a potential investor. What I do think they are doing, and what UEFA is helping with, is to create the effects of a closed league within an open league structure. I mean, when you're looking at the last pre-COVID year, and the bottom of the top 6 revenue at Arsenal is 2 times that of the club in 7th, West Ham, then actually you've got a structure in which, because the coefficient or the correlation between wages and finishing position is so close, and it's not 1-to-1, but it's close. It means that if you are making more money, you can pay better players and you will do better. And as a result, the top 6 is the top 6 is the top 6. I mean, I don't know if you've looked today, but the top 6 is the top 6. I looked today because I, as an Arsenal fan, was slightly worried about.
You're still there, clinging on to 4th.
Yeah, but I think the point is that you can make an investment of this type and feel fairly confident as an investor in Chelsea that they will continue to play European football for the next 10 years. And it may or may not be Champions League. Maybe they, I think probably a prudent business model would have seen them pop out, once every 3 years or something. I think that's probably how they've risk adjusted it, and they will have run scenarios to try and risk adjust it. But they will be assuming that they play European football.
But do you not think the Glazers were assuming the same thing about Manchester United, who are now?
No, they weren't. I know, because I ran the model.
Oh, okay. I mean, because I feel sort of slightly Manchester United is the outlier in this, which is they are struggling, aren't they?
Well, struggling and not struggling in that, I don't know if you can remember. I think Ed Woodward got his he got a little bit of stick for one investor call where he said it didn't really matter what happened on the pitch, the commercial revenues would still go up. I mean, I think there's a halo around Manchester United, slightly slipping at the moment, but it is it is, along with Barca and Real, the greatest football club in the world. I think most people outside Liverpool would probably agree. So I think there's when you have a brand like that, you can continue to have a slightly different approach. particularly on the commercial side.
Great, thank you. We're pretty much coming to the end, but I've got one or two things I just wanted to raise. One is a juicy bit of gossip which I picked up from a colleague whose name will remain anonymous, but there's a whisper that Jim Radcliffe's sort of last ditch effort to buy Chelsea was in fact putting himself on notice as somebody who's in the market for a Premier League football club. And as a Manchester United fan, as a well publicised Manchester United fan, Kieran, do you think that we might see an Ineos-backed bid for United in the not too distant future?
Well, given that Jim Ratcliffe said, was it 2 years ago, there's a mug out there that's prepared to pay $2 billion for Chelsea, and that mug's not me, and and then he then comes in with a $2.5 billion bid. I think he's realised from his involvement with his French club, from his involvement with the cycling team, that there's an awful lot of personal pleasure to be gained from owning a football club. As a lad from Oldham, what better way for him to have the Jim Ratcliffe legacy than to rescue Manchester United from the Glazers, and that's how it would be marketed. The Glazers made quite a bit of money from selling United shares last November at $21 a piece. They're now trading below 14. So they've extracted some money. When's the next time they'll be able to sell their shares for 21 or more per share? Could be a while. So this could be Jim Ratcliffe putting himself in the shop window, but he's going to have to pay a significant premium over the current price.
Do you think, Ronan, that would be, is that at parity to Chelsea, do you think? Are they in that sort of bracket, or do you think United would be at a premium to Chelsea?
I still think United would be a premium to Chelsea. I think actually, just if you're looking at where the share price is there at the moment, but that's people buying in minority purchases. If you're buying control of the business, you should be putting 20 to 30% on that, roughly. And that will put them at a premium to Chelsea when you add the debt in. So I think I think it would be a premium to Chelsea. We'd have the same discussion about justification of that value at that point, given what Chelsea are doing and how United are doing. I think United could turn that around very quickly and then get a manager that galvanises that particular dressing room, because it's not like they haven't got the talent.
Well, you've answered Neville's question right at the top of the call, which is, should we not all be buying shares in Manchester United based on Chelsea's valuation? So I'd say, Neville, get your cash out and buy now, because they're about to go up 30%. Brilliant, gentlemen. Thank you very much. And before we do go, I would just like to draw everybody's attention on the call to our upcoming course on the 23rd, 24th of May on private equity in sport. We've touched on a lot of that today. We've got 2 consecutive mornings of live sessions with some of the leading practitioners from across the sport and private equity space. So anybody on the call today who's really interested in getting further under the skin of this fascinating subject, you can click that green button that's down there. And there's an extra 10% off for the pleasure of joining us on today's webinar. So hopefully we'll get a few of you joining us for that. Just remains to say, for me, huge thanks, Roland. Huge thanks, Kieran. That really was a fascinating conversation. Football and Chelsea is the gift that keeps on giving for our webinars. So I wait with bated breath as to what the next subject will be. But if it's half as exciting and interesting as it's been today, then we're in for a treat. But everybody who's joined, thanks very much to you both, gentlemen. Thanks for joining us. Have a great weekend. And I look forward to being in touch with as many of you again as possible soon. So thanks very much. See you later. Bye-bye.